Hi, I'm Simone Richardson, financial advisor from Citadel Wealth. Debt is such a big part of the financial planning process. So this week I caught up with Edwena Dixon from Pinpoint Finance and asked her some of the questions that we get every day. I asked her, is now a good time to be fixing your loan? How are the increasing interest rates impacting your ability to get finance? And she also gave us some tips on how best to manage a simultaneous settlement. So I hope you enjoy the video. We've seen the RBA have increased the cash rate by 2.5% since May, which is quite significant. Are you seeing a reduced borrowing capacity for individuals as a result of the rising interest rates?
Yeah, what we're seeing as part of the increase in interest rate at that cash rate level, we're really seeing the flow-on effect. And the flow-on effect from lenders is coming through in different forms. So some of the lenders aren't necessarily passing on the full cash rate every single time. Some of them are only passing on a small portion, whether that's a 9% increase or whether it's a little bit higher than the full amount. Every lender is really making up their own rules, which they are their own businesses, and they're really then changing the borrowing capacity across the board, because the way that the banks look at somebody's income and expenses and then determine borrowing capacity is factored in, or does factor in, what the interest rate is at the time, and making sure that there's a buffer on top of that if interest rates then further increase. So over the last 6 months, we have seen borrowing capacities diminish if those people haven't received any kind of pay increase, if they haven't curbed their living expenses, and perhaps they were actually spending more than what they should have previously. But it is going to continue in that manner until things start to settle down in the market.
We're seeing a number of fixed loans maturing and the impact of increased interest rates really impacting borrowers' cash flow. Do you have any suggestions on how to manage this?
I think one of the simplest things that people can actually do in preparation for their fixed rate actually expiring, whether that's later this year or quite possibly early next year, when a huge amount of fixed rate home loans will actually come out of that fixed rate period, is for people to start almost pretending and practicing what their repayments are going to be like now. If you're on a fixed rate at the moment that's 1.99%, and come March next year, all of a sudden it's going to come out of that and you're going to be on an interest rate of 4.5%. That's a really big jump. So now's the time to start preparing, start pretending almost a little bit like your interest rate has already jumped up. Start making those tweaks to the way you're spending your money, you're budgeting your money, and also use that extra funds that you're setting aside as though you are already paying a higher mortgage rate. Put that into savings. Build that savings buffer. There's no better time to actually make sure you have a bigger savings buffer, so that when your fixed rate finishes, you're not sitting there going, we have no money, or we don't have as much saved up as what we thought we wanted.
That's really good advice, Edwena. We had a brief chat about this last time, and a completely off-the-cuff question. Do you know what those statistics are on maturing fixed-term loans next year?
I believe it's somewhere around almost, oh goodness, I'd have to go back and check. It was somewhere around like 190,000 odd home loans were going to be coming out of maturity by the end of this calendar year.
Oh wow!
Yeah, a huge amount.
Yeah, that advice you just gave is excellent advice. Fixed or variable? This is a question we get all the time. Is now a good time to do it? Has the horse bolted?
I feel like this is an age-old question. Everybody asks it constantly all the time. And a lot of it really has to come down to somebody's personal individual situation. Because at the moment, yes, we are in an environment where fixed rates are higher than variable interest rates. But if you actually need the certainty of a fixed rate for budgeting reasons, then having that fixed rate to reduce your own anxiety levels and to make sure that you're, actually going to be okay over the next couple of years for whatever reason, you've had a baby, I don't know, you're doing renovations, any of these things, these are all great reasons to get a fixed home loan. If you aren't in that situation, if you've already had mortgages before, if you know the costs, if you're great at budgeting, if you're great at saving, then the reality is you probably want a variable interest rate.
Very true. I guess a variable rate gives you the flexibility to make additional repayments using an offset account, etc. But having that security might be very important to somebody, particularly at the beginning of a big home loan.
Yeah, very much so. Yeah.
Okay, I've spoken to a couple of people lately who are looking to upsize, resize, downsize their home. And there's always that anxiety about trying to finance and have a simultaneous settlement. Could you tell us a little bit about that process and the best way to manage that?
So simultaneous settlements are probably more common than people realise. It's something that I think not everybody's really talking about. And a lot of the way that a simultaneous settlement will work is that if you are the buyer, and obviously as a mortgage broker, I work more with the buyers than with, vendors or sellers. But what we advise is really to pick which side of the process you're going to be more comfortable with. Are you going to be more comfortable selling your house first and knowing exactly how much you've sold the house first for? Or have you seen a home that you're sitting there going, this place is fantastic. There's no way I'm going to find a better home than this. I have to buy this property now. That's a personal decision. But once you've actually made that decision and you've followed through with either putting your property on the market and you've sold your property, or you've signed a contract to purchase a new property, you then actually have half of the equation sorted. At that point, we're then looking at the other side of the equation. And what you're wanting to do is make sure that the contract for both of these, the purchase and the sale, end up having the exact same settlement date on those contracts. Now, for many, the easiest way to do this is to actually have a long settlement. So it might be a 120-day settlement so that you have enough time to be able to organise the other side of that equation. The other thing that many people aren't aware that they can do is you can then also rent that new home that you're going to be moving into. You can often rent it from the vendor a week, a couple of days, 2 weeks, a month if you need to, before your settlement happens. And this then allows people to actually slowly start moving their things across. So you're moving all, the things that you need out of your house on that day, but you don't have to have filled up every truck in the state with all of your belongings, having them sitting outside of that new home, just waiting to be able to enter the property. The other thing I would say is in a simultaneous settlement situation, actually making sure that the settlement date isn't a Friday. Now, that might sound completely crazy to many people, but it does mean that if there are any delays in any part of this transaction, because you're selling your home. So there's people involved that aren't you and your solicitors and your mortgage broker. And then on the purchase side, there's also the vendors involved in that as well. And, all of their lenders, everybody else as part of that. There are a lot of different variables in that situation where something may be delayed. Now, if you have rented the property first, then you'll be able to go there. You'll be fine. You won't be homeless for the weekend. But if you haven't and you're not able to do that, actually having settlement midweek will mean that if there's any kind of delay, there's any hiccup in that process, it just rolls over to the next day. That's not so bad. But having to wait for your settlement, instead of it being on a Friday and getting access to the property on the Friday, having access to a property on a Monday, often that's too stressful.
That just all sounds incredibly stressful. We are seeing more lenders nearing retirement that still have loans or need to refinance or what have you. And some of the feedback I'm getting is that it can be a more difficult process. Do you have any advice or any comments, I guess, you want to make about this group of borrowers?
Yeah, and now I would say with these particular borrowers, it really depends on what is that loan or that mortgage attached to. If it is their own home and they have no other assets outside of that, the best thing that they really can do is focus on paying down that debt as fast as possible in whatever way they possibly can. If they are sitting there and it's debt associated with an investment, so an investment property, whether it's in their personal names or in an SMSF, that's a different story. So getting finance when you're a mature aged borrower for an investment, that, yes, it's still difficult, but it's not as difficult as if you're going to be getting finance for your own home. The biggest questions that the lenders are looking at and they want answers to is, if they give you the money, when are you going to be retiring? How are you going to pay those funds back? Because they're not going to give you a 30-year loan, because you might be 90 by the time that 30-year period is up. They don't want to be on a current affairs. It really is a case of, what's your plan to then pay that debt back? Because at the end of the day, you have to pay the debt back. And you're either doing that from paying the loan down or you're selling the asset.
Are you finding the terms being offered to a more mature lender are shorter and therefore impacting their ability to service the loan, so to repay to make the repayments?
Yeah, what we have noticed, really, I would say for the last 3 years, is that there has been a more intense effort by the regulators and therefore by the lenders to make sure that mature age borrowers are actually paying back the debt, but also making sure that they aren't taking on more debt than they can reasonably repay. So things like adjusting the loan terms down to, say, 15 years or 25 years is quite common. The other thing is, it really comes down to, where is their income coming from? If they're coming from their normal everyday PAYG job, that's one side of things. It's going to be a little bit trickier. If there is, they work at a PAYG job, but they also have passive income coming from, a share portfolio or from other investment properties, then that's a bit of a different story, because one of those sources of incomes will cease at a particular point in time, usually 65 years old, And people can choose to work up to 75, and that's fine. And some lenders will accept that, people like working. I'll probably be one of those people. But then you also have the investment side. So if you've got the passive income coming through from a share portfolio, managed funds, investment properties, that doesn't stop once you reach a particular age. So again, the lenders really are looking at, how is the money going to be repaid? Is it going to put somebody into financial distress and financial hardship? Is there a clear plan for how the money is going to be repaid?